If you're a UK expat or planning to retire abroad, the pension rule changes coming in 2026 could dramatically affect your retirement savings. Some of these changes could cost you thousands of pounds if you're not prepared. In the next few minutes, I'm going to break down everything you need to know about the new expat contribution rules, the controversial 10-year rule, and the critical deadlines you absolutely cannot miss. Welcome back to my channel, where we dive deep into the financial changes that actually matter to your life and your future. If you're new here, this channel is all about helping you navigate complex financial regulations, retirement planning, and making sure you're not caught off guard by policy changes that could impact your hard-earned money. Today's topic is absolutely crucial if you have any connection to UK pensions, whether you're currently living in the UK, planning to move abroad, or you're already an expat. The UK government has announced significant pension rule changes for 2026, and some of these modifications are going to affect millions of people. We're going to cover the new expat contribution limitations, the revised 10-year qualifying rule, tax implications, and most importantly, what you need to do right now to protect your pension pot. Make sure you stick around until the end, because I'll be sharing some actionable strategies that could literally save you tens of thousands of pounds. And if you find this information valuable, please hit that like button and subscribe so you don't miss future updates on financial regulations. Let's get straight into it. Before we dive into what's changing, let's quickly establish where we are right now with UK pensions. The current system allows UK citizens and residents to contribute to various pension schemes, including workplace pensions, personal pensions, and the state pension. For expats, the rules have been relatively straightforward, though not without their complexities. Right now, if you're a UK expat, you can continue making contributions to your UK pension for up to 5 full tax years after you leave the UK, provided you were a UK resident and contributing to a UK pension scheme before you left. This has been a valuable benefit for many people who move abroad but want to maintain their UK pension contributions, especially considering the generous tax relief available on pension contributions. The state pension situation for expats is also relatively clear at the moment. To qualify for the full state pension, you need 35 qualifying years of national insurance contributions. If you have fewer years, you receive a proportional amount. Expats can make voluntary national insurance contributions to fill gaps in their record, which has been an essential tool for maintaining pension eligibility. Now, let's talk about what's changing in 2026 and why these changes matter so much. The UK government has announced several modifications to pension rules that will take effect from April 2026, and these changes are specifically designed to address what policymakers see as inconsistencies and potential abuses in the current system. The most significant change for expats involves new restrictions on pension contributions. Under the new rules coming into force in 2026, UK expats will face much stricter limitations on their ability to contribute to UK pension schemes while living abroad. Currently, as I mentioned, you have 5 full tax years after leaving the UK to continue making contributions. The new rules will reduce this to just 3 tax years. This might not sound dramatic, but for many people planning extended periods abroad, this 2-year reduction could mean losing access to thousands of pounds worth of tax-efficient pension contributions. But here's where it gets even more restrictive. The new regulations will also introduce an earnings requirement. To continue contributing to a UK pension while abroad, you'll need to demonstrate that you have relevant UK earnings. This means income from UK employment or UK self-employment, investment income, rental income from UK properties, or foreign earnings will not qualify. This is a massive shift. Previously, many expats could continue contributing to their UK pensions even if their income was entirely foreign sourced, as long as they were within that 5-year window. From 2026, that door closes. If you're working for a foreign company or you're self-employed abroad, you won't be able to make new contributions to UK pension schemes, regardless of how recently you left the UK. There is one important exception to be aware of. If you're working for a UK employer abroad, or you're posted overseas temporarily by your UK employer, you may still be able to contribute, provided your employer continues to operate a UK payroll and you're still technically employed in the UK for tax purposes. However, the details on this exception are still being finalized, and it's likely to be quite narrowly defined. Now let's talk about what's being called the 10-year rule, which is perhaps the most controversial aspect of the 2026 changes. This rule relates to how long you can receive certain pension benefits while living outside the UK. Under current rules, if you qualify for the UK state pension, you receive it regardless of where you live. The amount is fixed based on your national insurance contribution record, and while it may or may not increase annually depending on which country you live in, your basic entitlement remains intact. The new 10-year rule introduces a significant caveat. If you've been living outside the UK for more than 10 consecutive years, and you have not made any voluntary national insurance contributions during that time, your state pension may be subject to a review. In some cases, if you haven't maintained any meaningful connection to the UK tax system, your pension could be reduced or suspended until you either return to the UK or make catch-up contributions. This rule is designed to prevent what the government sees as a situation where people work in the UK for the minimum qualifying period, leave the country, and then claim a full UK pension for decades without any ongoing contribution to the UK economy or tax base. However, critics argue this is fundamentally unfair. People who have worked and paid national insurance for 35 or more years have earned their state pension, and to suddenly tell them that living abroad for too long could jeopardize that entitlement seems like moving the goalposts after the game has been played. The good news is that there are ways to avoid falling foul of this rule. Making voluntary national insurance contributions, even minimal ones, every few years can maintain your eligibility. The recommended approach is to make at least 1 year's worth of voluntary contributions every 5 years if you're planning to be abroad long term. The third major change involves tax relief on pension contributions, and this affects both UK residents and expats, though in different ways. Currently, pension contributions receive tax relief at your marginal rate of income tax. If you're a basic rate taxpayer, you get 20% relief. Higher rate taxpayers get 40%, and additional rate taxpayers get 45%. This tax relief is automatically applied to personal pension contributions, though higher and additional rate taxpayers need to claim the extra relief through their tax returns. From 2026, the government is introducing new caps on the amount of tax relief available for certain high earners. If your total income exceeds £200,000 per year, the amount of pension contributions on which you can claim higher or additional rate tax relief will be limited to £40,000 per year, down from the current annual allowance of £60,000. For most people, this won't be an issue because they're not contributing anywhere near £40,000 per year to their pension. But for high earners who have been maximizing their pension contributions as a tax efficiency measure, this represents a significant reduction in the tax advantages of pension saving. There's also a new rule affecting expats specifically. If you're no longer a UK taxpayer because you're living abroad, you won't be able to claim any tax relief on UK pension contributions, even during the 3-year window when contributions are still permitted. This is a major change. Previously, expats could continue to receive basic rate tax relief on their contributions. From 2026, if you're not paying UK tax, you don't get UK tax relief on pension contributions. The fourth significant change relates to pension transfers, particularly transfers to overseas pension schemes. This is a complex area, but it's essential to understand if you're considering moving your UK pension abroad. Currently, you can transfer your UK pension to a qualifying recognized overseas pension scheme, commonly known as a QROPS. The rules around this are already quite strict, with various tax charges applying in certain circumstances. But transfers are generally permitted if the receiving scheme meets specific criteria. From 2026, the government is tightening the rules significantly. Transfers to QROPS will only be permitted if you're already a tax resident in the country where the QROPS is located, and you must have been a resident there for at least 2 full tax years before the transfer can be approved. This is designed to prevent what the government sees as pension liberation schemes, where people transfer their UK pensions to overseas schemes primarily for tax purposes rather than genuine retirement planning. However, it also makes it much harder for people who legitimately move abroad and want to consolidate their pensions in their new country of residence. Additionally, the new rules will introduce a mandatory 5-year reporting requirement. If you transfer your pension to a QROPS, you'll need to report any changes to your circumstances, including changes of residence, to HMRC for 5 years after the transfer. Failure to report could result in significant tax penalties. If you're already an expat, the most important thing is to understand where you are in the current 5-year contribution window. If you left the UK within the last 3 years, you'll be able to continue contributing under the current rules until your 5-year window expires. However, Once the new rules come into force in April 2026, you won't be able to make new contributions unless you have relevant UK earnings. If you left the UK more than 3 years ago, your ability to make new contributions will end in April 2026, regardless of whether your 5-year window has expired. This is a harsh but important reality to accept. For expats who have been abroad for more than 5 years, you need to focus on the 10-year rule and ensuring you maintain your state pension eligibility. Make those voluntary national insurance contributions. They're not expensive, and they could protect tens of thousands of pounds worth of state pension entitlement. If you're a high earner who has been maximizing pension contributions, the reduction in the annual allowance for tax relief is going to affect you. You'll need to reconsider your pension contribution strategy and potentially explore other tax-efficient saving and investment options. One approach is to make use of your spouse's pension allowances if they're not a high earner. Spousal pension contributions can be an effective way to continue building retirement savings while accessing tax relief. You might also want to explore other tax-efficient vehicles like ISAs more seriously. While they don't offer upfront tax relief like pensions, they do provide tax-free growth and tax-free withdrawals, and they're not subject to the same restrictions as pensions. Before we wrap up, let me highlight some common mistakes people make when dealing with pension rules, especially in the context of living abroad. Mistake number 1, assuming the rules won't apply to you. Many people think that because they've already built up a pension or because they've paid national insurance for many years, they're protected from rule changes. Unfortunately, that's not how it works. New rules apply to everyone, even if your contributions were made under old rules. Mistake number 2, waiting until the last minute. April 2026 might seem far away, but it's really not. Pension planning takes time, and if you wait until early 2026 to start thinking about this, you may find that you've missed opportunities or that you're rushing into decisions without proper consideration. Mistake number 3, not seeking advice. Pension rules are complicated, and the tax implications of getting things wrong can be severe. False economy is avoiding professional advice to save a few £100s, only to lose thousands or tens of thousands because of poor decisions. Mistake number 4, forgetting about voluntary national insurance contributions. These are relatively inexpensive but incredibly valuable. Don't let gaps develop in your national insurance record because you forgot to make voluntary contributions while living abroad. Mistake number 5, assuming you can't do anything because you've already been abroad for more than 5 years. Even if you're past the contribution window, there are still actions you can take to protect your pension entitlement, particularly through voluntary national insurance contributions. So there you have it, a comprehensive breakdown of the UK pension rule changes coming in 2026 and what they mean for expats, high earners, and anyone planning to live abroad in the future. These changes are significant and they're going to affect millions of people. But with the right planning and preparation, you can minimize the negative impact and protect your retirement savings. The key takeaway from everything we've discussed today is this: don't wait. The changes are coming in April 2026, but the actions you need to take should be happening now. Review your pension situation, check your state pension forecast, make voluntary national insurance contributions if you're an expat, and seek professional advice if your situation is complex. I know this has been a lot of information to take in, and you might be feeling a bit overwhelmed. That's completely normal with topics like this. My suggestion is to watch this video again, take notes, and then start working through those action steps one at a time. You don't have to do everything at once, but you do need to start. If you found this video helpful, please give it a thumbs up. It really helps the algorithm show this content to more people who need to see it. And if you haven't already, make sure you subscribe to the channel and hit that notification bell so you don't miss future updates on financial regulations and retirement planning. The world of pensions and tax rules is constantly changing, and I'll be here to break down those changes in a way that's clear and actionable. Drop a comment below if you have any questions about the rule changes or if you want me to cover any specific aspect in more detail. I try to read and respond to as many comments as possible, and your questions often inspire future video topics. If you're an expat or you're planning to move abroad, you might also want to check out my previous videos on international tax planning and managing your finances across multiple countries. I'll link to those in the description below. Thank you so much for watching, and remember, Knowledge is power, especially when it comes to protecting your financial future. Take action now. Don't wait until it's too late, and you'll be in a much stronger position when these rule changes come into effect. I'll see you in the next video, where we'll be diving into another important financial topic that could save you money and stress. Until then, take care and stay financially savvy. Make sure you stick around until the end, because I'll be sharing some actionable strategies that could literally save you tens of thousands of pounds. And if you find this information valuable, please hit that like button and subscribe so you don't miss future updates on financial regulations. Let's get straight into it.